Hello, everyone, for joining, and I want to thank you all for being here at this webinar series hosted by AmTrust Title and Ariel Property Advisors. My name is Matt Zabonic. I'm the Director of Capital Services at Ariel Property Advisors, and today with me I have Seth Weissman, Founder and President of Urban Standard Capital, as well as Brian Lutz, AVP and Commercial Loan Officer of Ridgewood Savings Bank, for our discussion on how underwriting has to change post-COVID. If you guys want to jump in, introduce yourselves, give a little background, and then we can dive into the topic. So Seth, feel free to go for it.
Sure. So first of all, Matt, thank you for having us, and Trust, thank you for having us. Always preferable to do these things in person, but for the time being, I guess webinars are where it's at. Just a little quick background on Urban Standard Capital. Urban Standard is a real estate investment firm focused on investments in the New York City, New York metro market. We have both debt and equity strategies, specifically 3 strategies, each backed by a discretionary private pool of capital. One does ground up development, another does value add repositioning and value add opportunities, and the third is a credit fund where we primarily make senior bridge loans, but also do some mezz and pref. Again, secured by assets in the New York City area, and typically to the sponsors and developers that are doing similar things that we're doing on the equity side of our business.
I guess my turn. I'm Matt, AmTrust. Thank you for having me. Again, my name is Brian Lutz. I'm a commercial real estate lender with Ridgewood Savings Bank. Ridgewood is a New York State chartered mutual savings bank. We've been around since 1921. Located in the Ridgewood neighborhood of Queens, New York. Our headquarters is still located in Queens, New York. We serve the New York metro area with 35 branches in Queens, Brooklyn, Manhattan, Westchester, and Long Island. At the present time, we're $6.2 billion in assets. We're a cash flow lender, so we lend on multifamily, pre-COVID, multifamily, mixed use, retail, office, some industrial. We don't offer construction financing, bridge financing, and we don't do any hospitality.
All right, perfect. I appreciate you guys giving a little bit of background. So let's dive in. So I think the first topic that everyone always asks about, especially when you're a broker, first question I always get is rates. And with the yield curves as flat as they are, and with the uncertainty in the near future, Seth, both as a buyer and a lender, and Brian as a lender, how are you guys seeing adjusting underwriting to rates? Are you guys looking to either give or borrow longer term money? Is shorter term money more of interest? How are you guys thinking about that?
I'll take that one first, I guess. We're a 5-year and 7-year product. We do have a 10, but we really don't go very long. We haven't been going very long on that duration. We have, obviously, with the treasuries where they are, we have adjusted rates. We're not as low as some other lenders in the marketplace. Mainly being we're not actively quoting. We're quoting, but we're being selective. So the deals that we're interested in, we're going to get our a little bit of pounded flesh on. Today, I'll just give you a ballpark. We're between 3.5 and 3.75 on 5-year money.
Got it. And Seth, as a borrower and as a lender yourself, how are you thinking about duration in this market?
Sure. Well, on the lending side with bridge loans, inherently our rates are, sort of our premium rates. Depends on the product, but generally starts in the sort of 8% range and goes up until to the sort of 10, 11% range. So in terms of duration, our average loan is about 12 months to allow people to bridge into stabilization. Usually that gets extended probably into a 15 or 18-month loan, but most people don't want to have longer-term financing out at those rates for obvious reasons. Although we are open to it if somebody wants to consider it. On the borrowing side, it really depends on the type of assets that we're borrowing on. We are buying we bought about 6 buildings in the last 3 months that have some component of value add repositioning. A lot of lenders, a lot of conventional banks that we do business with don't want to touch anything with the transitional component, even if it's a experienced sponsor with a strong balance sheet mean, we have about $300 million in assets under management. So I think for the sort of small to mid-market assets we deal in, I mean, we're one of the better capitalized sponsors. And so we're able to borrow at sub 4 rates on transitional product, but that's coming with either a guarantee from me or a guarantee from the fund or some type of credit enhancement that lets our capital partner get comfort if the underlying cash flow is not there in the short term.
Got it. And that's actually a great question. So since you're buying some of these value add properties, how are you looking at occupancy and vacancy and renovations these days? Are you focused on that? How are you underwriting that?
Sure. So, that's what I've always done, is bought buildings with either mostly vacant units or completely vacant. I mean, frankly, as an operator, there's a lot more scale and efficiency that comes with buying a vacant building or mostly vacant building. Anybody who's done a gut rehab of a multifamily or mixed-use building, or a major rehab of a building that's 100, 125 years old, the hardest part is sort of threading around existing tenants and wanting to be sensitive and careful about minimizing any impact to them. But again, when you're talking about a building that's of a certain age, it is hard to have a zero impact. And so we like to, when we're going to do the work, do 10 units at once, not do 2 units this year, 2 units next year, and so on and so forth. The challenge, I think, on the lending side is that obviously impacts your cash flow when you see that you've got effectively an 80% vacancy rate going in. Now, my goal is not to sit on my hands and just let the building sit vacant, right? I want to get to it, get the renovation done, and get it leased up. So it works for me and works for a lot of our clients on the borrowing side, but it may not work for a lot of conventional lenders who want to make sure that they have that cash flow. I do think one challenging element today is understanding where the stabilized rent levels are going to be, because that's a little bit of an unknown depending on the neighborhood and the product type. Like, we're doing pretty well with our studios 1s and 2s. Bigger share apartments are struggling a bit. So it's hard to know, the 3-bedroom, 1-bath share in Bed-Stuy that was $3,000 last year. Is it $2,800? Is it $2,600? Is it $3,000 but with 2 months? And where does that end up 12, 15 months from now? Is that back to where it was pre-COVID? Is it somewhere in the middle? Is it whatever? And obviously that makes the takeout financing a little harder to anticipate. And you obviously want to make sure you have enough of a margin that even if your rents drop a little bit and cap rates expand, that you have a takeout lender that's looking at your stabilized cash flow that won't necessarily require you writing a check at closing, to fund the permanent financing.
Got it. And Brian, that's actually a great transition. So when you're looking at deals, right, when we send you Seth's deals and you take a look at them and you cut everything, how are you guys cutting rent rolls now? How are you guys looking at expenses? Are you changing DSCRs? Can you pull it back a little bit and give us a little inside information?
Well, basically, we're taking a stress model and we're basically bumping up the vacancy by, like, say, 5% to see if it breaks even. If it breaks even, we'll that's the first test to go through. Like Seth said, we're more or less staying away from the shares for now. If I see a 4 or 5 bedroom apartment, I'm probably not gonna. I'm not gonna quote it, just because the viability of that type of space right now for the near term is in question. So we're seeing better success on deals with 1 and 2 bedroom and studio apartments, rather than the 3s. A little bit are okay, because if it's a family on a bigger unit, it might be a family in there in the Bronx or in certain parts of Brooklyn, we might be okay with it. But like a 4 bedroom or a 5 bedroom, we're staying away. We've always been conservative underwriters, so I usually, we might underwrite to a higher cap rate than what the actual market is, just to see what the metrics look like, and we're comfortable with it. We're seeing anywhere from 25 to 50 basis point increase in cap rates, depending on the neighborhood. And, from a rental perspective, it's still a moving target, because it really comes down to borough, neighborhood, and operator. If some of these operators, if they were reaching for the top of the market, obviously the rents are coming down and they're having trouble renting it or keeping tenants in there. The other operators who weren't reaching, they were happy with what they had, and it was in the middle of the range. They're doing better.
Got it. And in terms of your portfolios, has there been a borough, a neighborhood that's been stronger for you guys than others, or asset classes that have been stronger for you guys than others?
Well, right now I'm kind of immersed in the portfolio and forbearances and trying to get our loans that weren't paying back on a paying basis. And in discussion with the owners, we've noticed that Manhattan seems to be suffering more than the other boroughs. Brooklyn seems to be okay depending on the location. Again, it's almost going building by building. Every building and every operator has a story. But Bronx Bronx is tough. I know the collections are down. If you have a building that has a lot of agency tenants, those seem to be doing better because the state's still paying their share of the rent. As far as Manhattan, where Manhattan's really, in my opinion, is doing the worst because rents were high, and when all this happened, everybody I've had building owners tell me, well, about half of my building just got up and left, and they moved out, and they basically turned over the keys and said, I can't afford the rent, and we're leaving. So that's kind of where we are. On new deals, we're scrutinizing them heavily depending on where they are and the rent level. Pretty much that's the story from my end.
Got it. And I have to ask the question. So everyone's wondering. Seth, you can. Oh, 1 second.
I was just going to. Okay.
So, Brian, what percentage of the portfolio is still in business? I'm sure a lot of people want to know what's going on the lender side and how many distressed opportunities.
I'm not liberty to say how much is paying and what isn't. All I'll say is, we had a fair amount of mixed use, and those buildings, again, when I'm competing, we compete with NYCB and Chase and Signature. Well, Signature not much on rate, but NYCB and Chase, and we were losing out on the low leverage, really sweet multifamily deals. So, and we kind of moved into the mixed use arena, and those are suffering depending on what the tenant is. If it wasn't a COVID resistant tenant, right now they're probably in a forbearance. We gave everybody basically a 3-month forbearance, and if you needed additional time, which is what we're going through now, you have to show us why. And a lot of the commercial tenants are vacant, and some of the residential tenants, they've had to reduce their rent to keep the people in occupancy. So it's a moving target. I wish I had a firm number for you, Matt. I don't, because we're still pouring through this portfolio, and people are sending in their payments now. I mean, it's a mixed bag.
Got it. All right. Sorry, Seth, what were you going to jump in and say?
No, I was just going to say that, in terms of, rents and collections, we've seen a similar dynamic to what Brian put out in our portfolio. I mean, we have a very Brooklyn heavy rental portfolio, primarily residential, also northern Manhattan. Those have held up for the most part. The residential collections for us from March 1st through August were about 93%, which I think was pretty good. The commercial collections were in the 50 to 60% range. I've told you this already, but we have a couple liquor store tenants who have done great and paid in full, but we have other nail salon, hair salon, local restaurants that haven't been able to pay their rent in full. And depending on the size of your mixed use building, if you're 6 over a store or you're 4 over a store and your commercial represents 20-30% of your income and they're not paying, then that makes it hard for the numbers to work. But the thing I've been encouraged by is, one, we've been able to work with all of our tenants almost universally to get onto payment plans and to sort of defer and spread out the pain. So whether that's security deposits that are utilized and then replenished over the next 12 months, or adding a couple months of rent, and amortizing it over the balance of somebody's lease term, particularly for commercial tenants, that's allowed us to help our tenants, help us, and work with lenders on an as needed basis to get through this get through this period.
Got it. And I'm assuming, but have you seen a lot of deals that traditionally would have gone balance sheet lender, but have maybe a little bump to them that, again, a lender could have structured around in the past, but now you're getting passed left, right?
A ton. That's been the biggest change. I think we really started to see in June originations for that type of profile. So really strong locations, existing bricks, great sponsorship, but some value add component. And there could be cash flow or a near-term path to cash flow. But pre-COVID, you had lenders like Signature and Sterling and Modern that, with some structure and probably a 50 to 100 basis point rate premium, would do those loans. And either they're not doing those loans at all, or they're doing loans that are 50% or 55% of cost. And a lot of quality sponsors who frankly never would tap into the private debt markets are saying, well, I can get 70% loan to cost. I'm going to pay 8.5%, maybe 9%, but I'm going to get more proceeds. I don't have to bring as much equity. And they're also recognizing that, well, wait a minute, this money's only out for 12 to 15 months, ideally, and I'm buying this at a 10 or 20% discount to purchase price. So those extra couple percent for them is an easy trade to take advantage of the market dislocation. But it was interesting because in the early innings of this, in March and April and even May, the sticker shock and the bid-ask spread, I think people sort of expected, well, rates, the Fed funds is zero and so that should just trickle down. And it really moved the other way because spreads widened.
Right, spreads widened, and also you and lenders like you knew you were the only game in town, so you can essentially dictate a higher price, right? It's a simple supply-demand situation.
Sure.
And were you seeing specific asset classes coming your way more so? Like have you seen more commercial and retail come your way than multi, or have you still seen the same? Is it been proportionally the same?
It's a mix. I mean, we did a $9 million four building loan in sort of Park Slope, Carroll Gardens, and downtown Brooklyn. They were mostly in Boerum Hill. They were mostly residential, but it was, again, the 6/1 store. But the store was a bagel store, obviously essential, particularly in New York. The deli, right? They were businesses that were not operating at 100%, but maybe were operating at 80% and we're able to make it work. But we definitely still see the usual suspects in terms of major repositioning, ground up development. I need to close yesterday, but whatever the reason that people tap into the private debt markets, they are all there. But that, and that pricing probably is in the 10% plus range, and still harder to get. But everything from your mixed use and multifamily assets that, again, would have certainly qualified for more conventional financing pre-COVID.
Got it. And Brian, have you seen in the intake you guys have gotten over the past 6 months, whether you quoted them or not, have you seen different asset classes booming? Have you seen different, structures or different things than you normally did?
We're still seeing, obviously the amount of loans has dropped significantly, the inflow, but the deals that we are seeing are pretty much the same. We're still seeing a lot of multi. The mixed use, while we're kind of pushing that off, unless it's a COVID resistant tenant, and we actually have a relationship with the sponsor, we're probably going to pass on that. But we were still looking at some mixed use. Retail and office, we're staying away from, but we're still seeing it. I actually saw a nice retail building out East Long Island that we actually did. There was 3 or 4 credit tenants in there. I took a ride out there. It looked like a nice property. We put a bid in on it. Normally, in good times, we would just not ask for recourse, but in this instance, we did. And a 1.5 year payment reserve, and obviously we didn't get the loan, but my management was like, well, you know what, it's a nice building, it's still a very conservative loan to value, but we tied it up, and then they have scared the sponsor off. But we'll still look at things like that. I'm not going to say we're going to quote it or we're going to pursue it, but we are still open to looking at deals. But for the most part, we're kind of sticking to what we know. Our bread and butter is multifamily. We've always lent in multifamily since we got into the commercial real estate market. I would say 90% of my book is multi. So we're still going to stay in that space for the duration. I don't think we're really going to get away from that. The challenge is, what are the values? What are we lending on? So it's tough quoting these deals in this kind of a market, but we're just being extra conservative. And for the most part, my marching orders from upper management is, if you get the deal, great, but don't worry, don't stretch for deals. We do not want you stretching for deals. And for now, origination goals are kind of on the back burner, and we're looking at portfolio management is kind of the key. Retainage, we want to keep the good loans, so we'll get aggressive on existing loans so that we don't lose them.
Got it. And that's the way you're going to keep the book essentially floating for the next.
Yeah, that's kind of the main thing right now.
Got it. So I guess that's a good question, is what is the future? I would say Brooklyn seems to be a great borough that everyone loves talking about. What's the future of multifamily in Brooklyn? Rent stabilized, free market, mixed free market, 421A buildings, a mix of tenancy. I mean, Seth, what are you guys looking at on the acquisition side in that perspective? And is there a cap rate at which you say a rent stabilized makes sense versus a free market? And Brian, what is your position on sort of the lending of those types of assets?
Sure. So for us, I think a big change has been, and this is a little bit pre-COVID, even related to a lot of the rent law changes, is just to understand not what the future potential cash flow could look like. It's what is it today, and then everything else. Yes, there are different paths to increase profitability, but that's further upside as opposed to I'm going to buy at a 4 cap today with fake expenses and hope to grow the revenue enough to earn myself out of that. That world is dead. It was probably dead pre-COVID. And today, I mean, we're seeing, assets with real cash flow, and the stuff we've been buying. And Matt, you worked on our deal on Throop, which was an in-place 6 cap. We bought something in Hamilton Heights that was an in-place 7 cap. The sellers were long-term owners who, yes, they realized they didn't sell at the peak in 2015, 2016, but they've owned these buildings in 30 years, 20 years, 50 years in one case. And so they were ready to just take their money off the table. And yeah, they were selling to us at a number that makes sense. We obtained financing at the time, and I think it was in the lower mid 3s. I forget exactly, but if you could buy a building where the rents are, 20-30% below market, and all of a sudden it's not necessarily about that capturing that upside from the rent stabilization. It's more like I'm insulated because rents have to drop now another 20-30% before my rent is out of the money. I think I mentioned to you the other day, we have a character of a tenant, I will say, who is rent stabilized. I think he pays around $1,850 or $1,900 a month for a rent stabilized studio in Bed-Stuy and a walk up. And he always loves to talk about his rent stabilized tenant, status. And we're like, and sometimes there's a little dig about, I don't get treated as well as my market tenants. And I was like, you're paying more than market rent. So, please, we want you to stay. And it's a funny dynamic because at the time, pre-COVID, he did have a deal. Post-COVID, we're actually earning a premium on that, and he's sort of stuck because if he leaves, he loses what was a good deal. So it's like a very unusual relationship. We haven't seen that dynamic before. But all this to say that, I think if we find an opportunity where we can buy something with a really strong in-place cap rate, maybe it's mid-5s, maybe it's 6. It really depends on the underlying product, the quality of the building, and the location. And we can put on 5-year money, 7-year money, in the 3s, and still have some type of value add opportunity. That's interesting to us. And you don't have to do all the work to get the market rent that frankly is largely not where it was.
So if any sales brokers are on the line, send Seth every deal above a 5.5 cap, and he'll get back to you by tomorrow.
Yeah, just make sure there's actual expenses in there. I used to be amused by getting all the setups with no vacancy and credit loss and no super fee and no management fee, but I'm like 30, 40 buildings into owning, New York, and I've yet to see a building that doesn't require a super or have a vacancy or credit loss. Only in the mystery fantasy land of building setups do you see it. And I'm sure Brian sees that as well.
I don't mean to come off sounding rude here, but I've yet to see a broker send me a deal with expenses that actually made sense. They were realistic. So $200 $200 a unit for water and sewer is I don't know. People don't take showers in that building. So, we've always underwritten more conservative. One thing we've always done is
expenses up. I can let you know that it could be worse.
Yeah, please don't we're using 9, and I think even that's conservative today. So, it's the same thing. And just to piggyback off of what Seth said is, I think the 4 cap value add it's gone. It was gone before COVID. I don't think it's coming back in the near term. So everything I see lately has a 5 or even a 6. So, and we're kind of, again, we're stressing these deals extra hard, and we're really scrutinizing. We scrutinize the DHCRs to make sure that they're in compliance with the rent regulations. That's kind of one of our hot buttons. Our chief credit officer that's his thing, is make sure that the DHCRs make sense. So that's kind of what we're doing and what we're seeing as well.
And outside of that, how are you guys, when you do get my package and you ultimately go into it and tear it apart and bulk everything up, are you guys looking on the expense side? Are you guys looking at as an expense ratio? Are you looking at each individual line item to make sure it hits? Like, are you bulking those up? How are you thinking about those?
I go line item by line item, and sometimes the taxes are underassessed, so we might bump the taxes up a little bit. What I do is I try to anticipate what my appraisers are going to do, because we kind of use the appraisal as well. So I know what the appraisers are going to look at. It's as far as how they're going to analyze the building. So I piggyback off of that. Yours are not as bad as other brokers that send me deals. I'm not blowing smoke, but I've seen some that like you would just laugh. I go line item by line item. Right now it's hard to pinpoint an overall expense ratio. The smaller building with free market are obviously going to have a lower expense ratio than a 75 unit multifamily in the Bronx or the Heights that is, operating less efficiently, but it's a bigger building and it's a lot more maintenance involved.
Got it. And are you guys concerned at all? One of the big questions, even pre-COVID, I know I'm going back a little bit here, was the city is going to lose a lot of tax revenue because of these new rent laws, because there are not going to be as many mortgages and not upsizing, there's not going to be any sales. Or either on the purchasing side or the lending side, either of you, are you concerned with taxes going up? Is that even on the radar? Do you not even think the city would dare do something like that?
I have to think, from a lender standpoint, taxes are going to go up. I mean, the dollar's only going to stretch. You can only cut services so much. You're going to have to grow the revenue side of the balance sheet. And from a state perspective, where are you going to get where are you going to look to? You're going to look to property taxes. What that does to the market, I can't really predict. The rent regulations are kind of a death knell to multifamily for a while. I mean, it killed the business, but maybe it's a correction that was coming anyway. So yeah, I do think that taxes will be going up, water and sewer will be going up. When that happens, I'm not sure, but we do anticipate some growth in those expense line items.
Yeah. Seth, I'm assuming the same thing based on the nods.
Yeah, I mean, on the equity side, we own a lot of sort of class tax 2 buildings, right, that are protected at sort of at the state level. I think that's harder to navigate, and it's a political total quagmire to try and change those laws. Also, for New York City, you're going into a mayoral election year, and I think that's going to make it a little bit harder to raise property taxes, and makes things like a pied-à-terre tax or the millionaire's tax probably an easier path than impacting property tax bills. But no, the city's going to have a little bit of a challenging, certainly, year ahead. I'd like to hopefully see them try to more encourage economic activity than take steps that will encourage taxpayers to leave. But the recent history of leadership at the city level, state level, in my view, leaves a lot to be desired. And hopefully this situation is a wake up call, and maybe there's a little bit more discipline going forward.
Got it. And so moving away from the multifamily for a little bit, I know it's what most of you guys focus on, but another big question that's going around is specifically retail and office. We'll leave hospitality alone for a little bit because I think it's its own beast. What do you guys see as the future, whether it's to the point earlier of retail in the base of a mixed-use building, standalone retail, standalone office? Are you guys preparing for those markets to change? Are you thinking about the future of how retail looks? What's sort of the thinking behind that?
I think retail is going to be a challenge for the next 12 months until we get back to normalcy, and even then it might take a few years to rebuild the economic distress that's come from this. So I would say that on a retail side, we're going to look really specifically at the type of tenant, and the concentration of the tenants in the space. If you've got 3 restaurants in there, I'm probably not going to lend on it. But if you've got like a liquor store, the normal, taxpayer that you would see on the corner with maybe a liquor store, a bodega, just the dry cleaner, we'll do that. We're probably going to be very conservative from a leverage standpoint, maybe 55, 60%. We were closer to 70% at the when things were humming along. We would do a 70% LTV retail property and not think twice. Now that's changed. Office, it depends. Obviously we haven't done any high rise. We don't do anything in the city. We don't have any product in the city. I think we have 1 building. But so our office is low, 4-story office building. Again, it's going to come down to the type of tenant in there. I actually did a walk through with last week with a borrower, and one of the tenants grabbed us in the hallway and he kind of started saying, "Listen, I'm a doctor. I'm not seeing as many patients as I used to. I can't afford the rent." Obviously, the owner was trying to push me out the door, so I didn't hear this, but we're hearing that story more and more. I can't afford to pay what this rent. So now the landlord is, he's in a bind. I get it. We want the landlords to work with these tenants also. We're not draconian and say evict them. They can't evict them, but we want you to work with them. But at the same time, I'm going to lower my rent. If I lower the rent and then things start improving suddenly, now I'm stuck with a low rent for a while. So I get it. It's a work in progress. I think this is evolving every day. Again, they just extended the foreclosure moratorium a month. So, it's a moving target, and you're trying to lend in this environment. Again, I'm a regulated entity, so I have to lend. I still have CRA issues that I have to maintain, but at the same time, I'm also on the other side. I have depositor money that I have to protect. We are well capitalized, fortunately, so we don't have to worry about anything coming from that. And then at the same time, we also don't know how the regulators are treating these loans, from a classification and a risk rating perspective. We've got some guidance, but not a lot. So it's an evolving over time process.
Yeah, that's interesting. I'd like to hear Seth's answer on this, but I want to go back to the regulators, because that's an interesting concept that I don't think a lot of people have even thought about yet, right? How are regulators looking at the changes? Mm-hmm. But Seth, just if you want to give your quick thoughts on office and retail, I'd love to hear them.
Sure. I think retail, again, pre-COVID wasn't exactly doing so great. So, particularly retail that, retail tenants who weren't making their money in this space, right? There's been, particularly in parts of the Upper East Side, Fifth and Madison and Soho and other pockets, Bleecker Street, where it was a marketing angle. And that's why, rents on Bleecker got up to $300 to $400 a foot. That never made sense. They couldn't come close to generating the economic activity in that space to justify the rent, right? The actual space probably justified a $150 to $200 a foot rent. And that was being reset pre-COVID. I think that trend, continues, right? People need to have a business that can make money in this space, and that could put significant downward pressure on rents. The type of retail that we own is really community neighborhood retail. It's your bodega, it's your hair salon, it's your local coffee shop, it's your liquor store, hopefully. And those I think will continue to do certainly relatively well or well. And they're surviving. If there's a second wave, it's going to be harder. But we are working very closely with all our tenants because it's in our, ethically, and it's generally our approach to try and figure out a solution that can work for all sides. But it's in our best interest, and it's in our city's best interest for these tenants to survive, right? If they go out, you're stuck with vacant space. You got leasing commissions. You don't know what lease you're going to be at. That's not really a great outcome either. So yeah, there's delays related to the eviction moratorium and foreclosure challenges, but practically, I don't know that those outlets are really viable outlets anyway, because where does that actually leave you? Whether you're a lender who now has non-performing loans and foreclosure, or you're a property owner who's starting a lengthy process on an eviction to get to a point where you may be not able to find a tenant anyway for 12 months. So those options aren't great options. I think it's a better option to work with people. But when we look at new loans, and we've done a bunch of mixed-use buildings with retail, is this essential retail? What does it, insensitizing what their cash flow looks like if that business rent gets cut in half or gets cut down by a third, for 6 months or a year. And we always encourage our borrowers to don't go crazy with pushing leverage, because if something goes wrong, then you're backing yourself up into a corner. And a lot of borrowers, they want to push leverage, but what I tell people is, like, you're putting yourself in a challenging position. I just had this conversation with a big sponsor last week who wanted to undersize the reserve, and from 12 months to 6 months. And I was like, we're walking into the city reopening in the fall and winter, potential issues related to a second wave we don't know. We have an election coming, which is going to be, who knows what's going to happen and what that's going to mean for the city. So don't take that risk today, because you do not want to be having to come up with additional capital in December or January. Make sure you have enough runway to get through this. And, eventually they came to that. And I was a little bit like, helping somebody get out of their own way. And, similarly with the office stuff, it's, what's the type of product? I think the sort of lower rise, more boutique office is going to fare a lot better. We don't have a ton of office loans, but we have a couple that are, a lot of sort of, 2,000 square foot or 2,500 square foot spots in, buildings that are 6 stories and less. I actually think there's going to be a demand for that versus being in a WeWork where all the shared amenities are all of a sudden now a liability, right? Yeah. It was great to have a beer on tap, but now nobody even wants to touch the handle. So, that's not that helpful, or share the conference room. And I think boutique product actually could do okay. I think people are a little concerned about taking space in a WeWork, not only because of all the common elements, but also because of the uncertainties related to the stability of that entity. And all of a sudden, these smaller projects, we're doing one in Gowanus now, that's an 18,000 square foot boutique office. They're taking bridge money. The guy has done it numerous times. He's showed that his tenants are paying the rent. We feel very confident in that market. But again, it's about sensitizing your exposure and making sure you have a plan B and C if you run into near-term obstacles.
And when someone shows you a new deal that has retail in it, and if it is a larger percentage of the building, it's like 20% or more, and it's vacant, is that a hard pass for you guys these days? Or are you just saying if the market rent was $40 a foot, I'm not saying $30 a foot?
If it's vacant, we're just going to underwrite the cash flow. We might go, hey, if you want to take a shorter term, maybe a 3, we'll do that, and then that gives you an easier. If you do end up getting it rented, we have a flexible prepay. We can refinance it. But we have a couple actually right now that we have in process that basically management said, well, we're not underwriting projected income, obviously. And back in the pre-COVID, we would structure that deal with a master lease or something or maybe a holdback. Master leases, we're not looking at it. We're not entertaining, because honestly, I can't rely on anybody's cash flow with it right now. I don't know what their whole global cash flow situation is. So we're underwriting just the in-place cash flow.
Got it.
And for us, again, similarly, we will look at a sensitivity to the rent, but we're also typically having a full reserve for our term, whether it's 12, 15, 18 months of interest anyway, right? In a non-cash flowing property, there's not the cash flow to pay rent. So the fact that there's not rent in is not that big of a change of dynamic, but we do look to, we are careful about what the rent level was and what it will be and what that looks like for takeout financing in 15, 18 months, and making sure that there is enough margin there. Recourse, certainly if the borrower has a substantial balance sheet, that certainly helps, but I think we will certainly consider it and we will do it. It might be a little more expensive. The proceeds might be a little bit tighter, but what we're seeing is we are seeing those deals because, as Brian said, a lot of banks that previously would have looked at it won't even look at it or won't give you any credit. So the fact that I might be willing to give you 50% credit makes our loan a little bit more attractive.
Got it. Okay. I think that's great. And then, Brian, I want to go back to the regulator question, because I know whether it's Seth or any of my other clients, the second I use the word regulator, it's like the boogeyman and they don't think it's real, and I get chewed out. So I'm interested to see.
It's real. It's real. Believe me, it's real. Again, I'll let you know in 8 weeks, 8 or 9 weeks. I do have the state coming in for a safety and soundness exam starting next week. So this will be an interesting events for us. From a guidance standpoint, it's been very minimal. The initial CARES Act came out, and basically the OCC, the FDIC, where FDIC and state, they were more or less they were basically saying work with your borrowers. The only guidance I've seen since then, and maybe I'm not privy to some other lenders who have gotten it, is again, if it was cash flowing, if it wasn't late, 30 days late pre-COVID, we don't have to classify the loan as what's called a troubled debt restructure, which means I have to add on additional reserves. But at the same time, in the same document, it says, but you still have to risk rate your loans like you normally would. All right, well, how do I risk rate my loans like I normally would when I have basically a quarter's worth of income gone? And now they're in a covenant default because it's it doesn't cash flow at 125. So it's going to be an experience to see how they treat this issue. It may be premature because, again, this is kind of still evolving, so maybe they won't be so draconian, but I've heard other banks going through examinations and they were put through the ringer. So, and they just said, add reserves, downgrade this, downgrade that. And again, when you're downgrading loans, I'm making less money on my portfolio, and it's a whole bunch of other things I have to do to get that, from a classified asset into a performing asset. So it's, again, I wish that we would get a little bit more, instruction on how they're going to be treating this, but from my understanding, my old man, my father was a regulator, so he's basically said the same thing: is they're not going to go on the record on anything. They're going to leave it to you, and then they're going to criticize you if you didn't do it the way they wanted you to do it. So that's the nature of being a bank in this day and age.
Got it. So they're not telling you to change DSCR at this point. There's no guidance in terms of how you underwrite it. Got it. No. Look, I think that's going to be a fun experiment.
From an asset classification standpoint, they just said, this is not considered a classified asset if it was paying pre-COVID, and that if they're in default now or they can't pay because of COVID-related issues. Which what is it related to COVID? What isn't a COVID-related issue nowadays? But say, which I'm kind of waiting to see is, all right, I've got a bunch of loans that are going back on a paying basis, and they're, we're basically deferring months to the back of the loan, so to the balloon. What do I do now on those loans that say I still can't pay you? I've got a guy in the East Village that this building, is in a great location. He has a restaurant and a clothing store and 3 apartments above it in the East Village, and he can't open his the restaurant can't do outdoor seating because it's a fire hydrant in front of the building. So what do I do with that guy? That's one of my best borrowers. Am I supposed to downgrade that loan now because he can't, because the city waited till, next week to open restaurants? And it's a challenge to risk rate these deals.
And that's a great question. How are you guys looking at the future, right? Because I think, Seth, you brought it up very briefly a few minutes ago, but when you look at a deal, whether it's 12, 20, 15, 18 months or 5 years, how are you doing the takeout scenario, right? I know that's a big underwriting point for a lot of lenders on both sides of the aisle. How are you assuming rates? How are you assuming growth? How are you assuming cap rates? Like, what are you thinking about there?
So for us on the value add transitional side, rates have been low for a while, but we haven't, and even pre-COVID, they had lowered rates. But we always sort of upsize based on debt yield anyway, because that's what the conventional banks were doing. So we, yes, somebody could borrow and make something make sense in the threes, but we were always using a higher number and also making sure that enough value was created in the value add that they had that coverage. I mean, that's something one of the metrics in all our investment memorandums for our loans is what that takeout coverage looks like. Assuming a fairly conservative set of debt service coverage, interest rate, to make sure that there is a margin of safety. And we continue to do that with our underwriting for true value add product. If somebody is actually executing on that plan, that is a pathway that should still work.
Got it. And Brian, what about you guys? How are you looking at your loans?
Again, I'm not as, down. I think that rates will stay low for 3 or 4 years. So we're mindful of that. That's obviously going to create spread compression. Hence, we might be thinking about going longer because I can at least pick up a little bit of spread on a longer term, considering I don't think I have the interest rate risk that we had. There was a lot of worry 10 years ago that rate, in 10 years time or 5 years time, the 3% is going to be a 6%. We never hit the 6%. So, I think the rates will stay low. From a cap rates perspective, we're going to underwrite conservatively, until we see a difference in the market and we have data that supports it. We're probably going to say, hey, we'll size this it's probably a 5.5 cap, 575. Let's see if it works at 6. If it works at 6, and offer it and see if they take it. I don't think there's going to be the urgency to put money out right away due to for sake of putting money out. Where it's going to be more about, all right, is this a safe loan to make? Are we going to get repaid? Do we know that this is, are these tenants going to pay, especially on a retail, if it's a mixed use building, what type of tenant it is? It's going to be a case by case basis, but I think we'll pull out of this at some point, obviously depending on, the vaccine or whatever COVID, issues we get. There's a second wave, which I have a feeling there might be another one, a short one. I don't think it's going to be as duration as it was before. We'll have to pull through it and then we'll reevaluate going forward.
And have you guys considered doing a longer term loans with some short IO in the beginning in order to give some initial relief, but have enough time to pay down the loan over the term?
My guys are not IO. We're not really a big IO bank. We're probably going to be if we ever get back into the IO market, at most 2 years, and that's where we were before. We're a conservative mutual savings bank. We don't have, we don't have the street till, we don't have shareholders. I don't have to worry about, reporting to the street. So I think we'll stay that path for the near term. But I do think we should do more longer term money. That's something that I've been kind of pushing to say, let's, maybe it's time to do some 10s. We're leaving spread on the table at this point. If it's a good loan and we want, I think we should do it more 10-year money.
All right, perfect. So I just noticed we are getting to the end of this. So, this has been great. I wanted to get both of your feedbacks on what is the next 12, 18 months, 5 years look like? What is your outlook on the future? What are you bullish on? What do you think is going to, obviously outside of retail, what's going to be a problem, and where do you see New York going?
I think the next 12 months is going to be basically mining, going through your portfolio and making sure that you can get these loans back on a paying basis, loan rate structures. You may have to do some, forbearance, loan, maybe going IO on a forbearance deal just to get the guy to be able to have enough cash flow to pay something. And a lot of loan workout. I think you're going to see banks adding a lot of workout staff. I think you'll see once the foreclosure moratorium is ending, I think you'll see a lot more lenders start selling notes into the market. I think the note sale market will be, exploding. At the same, you'll have to see what your pain threshold is from your charge-offs, how much you're willing to if you're willing to eat 50 cents on the dollar, it might be worth it. Instead of sitting on that for 4 years in a foreclosure. I don't know if it's going to be as bad as the last foreclosure. I was in the workout during that time too, and basically the courts just grind it to a halt. On the resi side, we still have loans from 6 years ago that are still in foreclosure. So it's time, and I think that's where you're going to see the next 12 to 18 months is a lot of that. And then, again, if a vaccine comes out in this third quarter of next year, you might think to see improve suddenly, and banks will start putting out money again because you're going to have to you have to get that stock price up, and you're a lender. You got to make money that way.
Got it. But you believe New York is going to bounce back?
New York will bounce back. I don't, it's just a matter of how long it will take. I don't think, we bounced back from the last recession. Again, we have more headaches. The problem is we have more hurdles now because of and I think part of that is the rent regulation law is you may not have as many buyers for these assets. You're going to, you might see the one-off guy disappear, and the bigger families who, how to run these buildings, they may step into the breach and maybe buy some of these notes from you, and or you may be, they may buy the building and do a short sale. I think there'll be more of that. But I'm bullish on New York long term. Again, I'm going to say that with the caveat of whoever the mayor is and whoever the governor is.
Right. And Seth, what about you? Short term and long term outlooks?
Sure. I mean, I think in terms of short term on the debt side, I agree with Brian. Like, you're going to start seeing a lot of more activity on the note sale side. I mean, we found pre-COVID, because we buy some NPLs, but not a ton. But we found that there was, as I'll say politely, an unwillingness to recognize the impact on loan value related to the rent law changes, right? So, one big lender, not Ridgewood, but another very active rent stabilized lender that had been very aggressively making loans that were 65, 70, 75% loan to value pre-COVID, that were, rates in the threes and very secure products. So they were comfortable stretching on proceeds a bit. Well, rent laws at least knocked 10 to 15% of value off of prices, right? So if you had a 70% LTV loan, and now all of a sudden the value has dropped by 10, 15%, and you effectively have an 85% LTV loan that's only generating a mid 3% yield, that's very hard to sell and not take a significant discount on it. And there was a reluctance to realize that. And then COVID hit. So now I think for some lenders, that is going to be a 50 cents on the dollar number. And then there's a question of, do we take 50 cents on the dollar, or is it a good borrower where we want to do some type of workout with? Ultimately, those will be decisions that each lender will have to make. But I do think that will, volume in that market will certainly step up. And I've seen the number of brokerage firms that have added workout specialists and loan sale specialists. All of a sudden, I don't know if a lot of people are rebranding themselves as that, but been getting a lot of emails about that recently. But it's going to be a choppy next couple of years because the courts are going to be clogged. They were not exactly expedient to begin with, and now with this volume, I think it's going to be it's even more of a challenge. I will say long term for New York, I'm certainly bullish on the long-term prospects. I mean, you've seen some big lease signings from tenants like Facebook taking over 700,000 square feet. Raymond James took, I think, 250,000 square feet. TikTok took 200,000 square feet. Amazon, despite the headquarter debacle, is still increasing their physical footprint. Google is building their downtown campus. Disney is building their downtown headquarters. So you have real firms with a big employee base that are making decisions for the next 5, 10, 20 years that are moving forward with their commitment to the city. And I think that bodes well. There is a leadership challenge. I mean, I saw today that the Speaker of the City Council dropped out of the race for mayor. Frankly, that's a good thing. He has not been, he has not been an ally for the economy or for business, for growth. It'll be interesting to see who steps into the void. Hopefully, it's somebody who recognizes that for the city to be a progressive city, it really needs to be a prosperous one. I mean, we need the economic activity to generate the tax revenue to pay for a lot of these programs. And I think people are learning a hard lesson. They're going to see, well, what happens when there's not transaction volume driving transfer taxes, and what happens when the mortgage recording tax is not, filling the coffers, right? I mean, these are huge swings in proceeds, and it's not so easy to tax people who can get up and move to Florida or even just move their primary residence. I mean, the number of people that, we manage money on behalf of foundations, family offices, and ultra high net worth individuals. The number of people who are already moving to Florida, had moved to Florida, and with COVID are not in the city for the last 6 months. And, there's an argument, I guess, that they don't have to pay, New York City taxes. I don't know, I'm not a tax person, but point is, it's on people's radar, and you don't want that. You don't want I think Cuomo said that the top 2% of taxpayers in New York pay 50% of the taxes. So, that was in the New York Times a week before. Well, if those people start to move or don't invest in the city, well, that's a real problem. And as somebody who raises capital from these types of institutions and foundations, and then I would say of the 100 conversations I've been having, only 30 will put money into New York at the moment, right? And they're looking for distressed prices. 70% of people are saying, talk to me in 6 months, or their outlook for the city is really bad, because New York, and it happened yesterday with Industry City being shot down. A lot of the elected officials have sent a message that New York is closed for business, and that's a tough message for people to attract capital. It makes it harder for recovery. And the rent law stuff, as Brian said, like where the buyers are not going to be there in the same way that they were. So all that stuff is going to have a really negative impact, unless there's some type of turnaround and adjustment in policy.
All right, perfect. I think that was great. So I think we are at time here. So I want to thank both Seth and Brian for being with us. Your insights were great. Hopefully we can get an update from both of you in a couple months as time goes on. I also want to thank AmTrust for hosting us, along with Ariel Property Advisors. Appreciate everyone coming out here, and hopefully as this starts getting better soon, go get back to work in the very near future.
Well, thank you again for having us.
Yeah.
All right, guys. Thanks so much. We really appreciate it. We'll look forward to speaking soon.
Thank you. Bye.
Thank you. Have a good one.
Bye.